Am I recording?
Yes, I see it's recording.
I think it's recorded under a Zoom, bro. So later maybe you need to check.
Recording. Oh,
Yeah, I think it's not
Yeah,
under
yeah.
my side. Yeah,
okay, can.
no problem.
Okay. I think we can still wait for about 1 minute for more people to come in if there are any. Okay, I think I will start now. Okay, hello everyone. Welcome to the part 2 of Power of Options, the options basic strategies. So before we start, I would like to wish everyone happy Chinese New Year. And so uh, we have a few participants here. I think some of you may have joined the part 1 of this course as well. So if you have not joined the part 1 before, make sure that you go to watch a recap on the part 1. Later I will be sharing on the link itself on where you can access that part 1. So let's move on. A disclaimer. This is just for educational purpose only, and it's not a recommendation to buy or sell anything. And please do your own due diligence before taking any actions. And for the takeaway of this lesson, I hope that you all can understand what is options, learn the basics of options contracts, learn the value of options, and learn how to use options to accelerate your returns with controlled risk. So before I start, I will be talking about myself. I will be introducing myself. I'm born in Malaysia. I'm a graduate from NTU, Singapore. And I'm currently an application engineer in the automation industry. I started stocks and options trading in 2020, in the year 2020 when the COVID happened. And I'm now managing a diversified portfolio and also a new website. It's the website is called thejourney-to1mil.com. So in my website, it actually look like this, and I will be updating on a few posts as we go along this year. So as you can see, I've updated on Bitcoin, and this is where you can find the part 1 of this course. And then I have also introduced my 2021 watch list. So later on, you guys can go to this website to have a look for yourself. Okay. So before I go into part 2, I would like to do a simple recap on the things that we touched on part 1. So basically, part 1, this is the big picture of options contracts. So as you can see, options can be differentiated into 2 types. One is call, and the other one is put. And you can buy or sell a call or buy or sell a put. So for if you want the stock price to go up, if you anticipate to go up, you use buy call and sell put to so that you can profit if the stock price go up. And as a opposite, the buy put and sell call, you want the stock price to go down. And as you can see here, buying of call or buying of put gives you the right to buy or sell the stocks at a particular price. And both buying, you need to pay a premium. As for selling, you are promising to sell or buy the shares. So in this way, you have to have either 100 shares if you want to sell call, or you must have the enough cash to buy 100 shares if you sell put. So these are the simple basics of the options. So this is also another recap. What gives the options contract is value. So as you can see, there are two things: intrinsic value and extrinsic value. The intrinsic value is uh, the value that the stock price have. It is comparing the current price versus your strike price in the contract. So if the current price is higher than the strike price, then your call options would have some intrinsic value. As for extrinsic value, there is a time component and IV, implied volatility. So what is a time component? As we all know, options contract have the date to expiry. So eventually the options contract will expire at the date of expiry. And the time decay faster when we are closer to expiry, as shown in this graph. As for implied volatility, it is showing market's forecast of a likely movement in price. So if it is expected to move up or down very much, then it is very volatile. So the IV will be high as well. Okay. So additional information here, which I think I have touched a bit on in the part one, is regarding this open interest. Open interest indicates the total number of options contracts that are currently out there. These are the contracts that have been traded but not yet liquidated by an offsetting trade. So it means that it is a open trade which they are looking for either the buyer or the seller to make this contract to close up the loop of the contract. So if the open interest is high, it means that you have a high chance of closing the loop if you want to buy or sell the options contract. And the next term is called delta. Delta is actually the amount of options contract that will move when the underlying price moves per dollar. However, delta is not constant. This one, we must remember this. Delta is not constant, and it can be affected by a lot of other parameters. But what we need to know is just what the value represents. So the value is actually representing how much the options contract will move when the stock price moves every dollar. So far, is everyone okay with this? If you are okay, type in 1 so that I know you guys are following. Okay. Okay, good. Okay. So next, I'll jump right into the part 2, which is the options basic strategies. So there are many strategies out there for options trading because options you can buy and sell, and there's also calls and puts. So the combination out there to use can vary a lot. So there is a lot of strategies, but it is best to just keep things simple. And the basic strategies I would like to talk about today is this. The first thing, you must invest in good companies at reasonable price. Then I will go through how to buy long-term call. Next, sell short-term put for income. The fourth one is sell short-term call for income. The last one, buy short-term put to hedge. And lastly, always remember to portfolio size. So the first one, invest in good companies at reasonable price. So as we have went through the past few courses with Joe, we have teach about fundamental analysis and technical analysis. So basically this part is we must always do fundamental analysis and technical analysis even when trading options, because options is actually reflecting on the underlying stock. So what is a good company? A good company is that the company must be profitable and they are in good financial health with wide economic moat, and also have the opportunity to grow, and it will still be around for at least the next 10 years. So where to find all these companies? You can actually look around you. What do you use? What do you see around you? And what is your employer using? So for example, your phone, your wallet, your charger, your laptop, your computers, all these things you can consider. And this website, finwiz.com, you can also actually go to this website to have a look on some stock screeners for some ideas. And the next thing is how to find the company's information. The first one is actually you can go directly to the company's website to take a read at their investor relations. They will update everything on their website. So other than their website, you can go to morningstar.com and finance.yahoo.com to look at the company's balance sheet as well as financial health. All these we have actually gone through for the past. So if you want to read in more detail, you can do so. Later on, we can share the link. So after the fundamental analysis, okay, the first one is how to tell if the price is reasonable. So we use fundamental analysis to analyze if the stock price currently is reasonable to buy in or not. And then how to tell if this is the time to enter. We use technical analysis to know if this is the time to enter the stock for the company. So in summary, make sure you know your fundamental analysis, technical analysis, as well as the options basics, which I have covered in part 1. So before we jump into the strategies, I would like to talk a little bit about navigating the user interface of TD Ameritrade, because this platform is mainly what I use to do my options trading. So if you do have a TD Ameritrade account, then you can learn how to use it here. So in your account, this is an example, the Tesla stock, TSLA. So in the options chain down here, the left side, you will see the contracts and DTE. So basically, this shows all the date to expiry of the contracts. And this bracket numbers is actually with regards to how many days left, how many trading days left before it expires. And as for the right side here, it is the IV percentage. So as you can see for Tesla, because Tesla has been, the stock price has been moving up and down quite a lot, so it's quite volatile stock. That is why the IV percentage is very high. As you can see, it's above 70%. And the next thing I want to talk about is this. There is a small section where you can open up. It's called today's option statistics. So you can also actually see on your left side the current IV percentile. But what does this mean? It means that for the past year, is the current IV considered high or low as compared to the whole year itself, the whole year average. So if this stock, Tesla stock, is actually volatile throughout the whole year, it means that the percentile is actually only 19%, which is quite okay for you to trade as well, even though the IV here is very high. So this is also another factor that you can take a look at for trading options. So after you've chosen a date to expiry, you open up and there will be a drop down menu. So these are actually all the options contracts that are available. So on the left side, this one you need to have some settings, do some settings to call out the columns that you want to see in TD Ameritrade, but I will not go through them here. So for me, I will be having the delta column, open interest column, and also a probability column for my own study to use. And the delta here is actually, as you can see, for the options contract, the individual delta will vary across different strike price. So for example, a strike price of 800, the delta is 71.71. But you must remember that one contract is equals to 100 shares. So you need to times 100, which is $71. So basically what this delta means is that when the Tesla stock price moves $1, either positive or negative, your options contract will move $71 in the positive or negative as well. So this basically what delta means. For the second column is actually on the open interest, as I mentioned just now. Open interest is actually showing how many open contracts are out there that you can trade. So if the number is higher, it means that a lot of people are trading that particular options. So yeah. Okay, so is everyone clear about the navigation just now? You can type in one. Okay, I see a question from Joe. What will be a good IV percentage for us to open an option trade? Do we use IV or current IV percentile? Actually, I will be going through what IV is the best to enter, and based on different scenarios, we can also use current IV percentile, because as you can see in the Tesla stock, it's actually volatile the whole year. So it's impossible to get in a trade if you just look at the IV itself. But if you compare the current IV percentile, you can directly know that current IV is actually not too high compared to the whole year itself. Yeah. So I hope that answer your question. Okay, so let's jump right in. This is the first strategy, which is the most basic and the best strategy to implement for options contract. It is to buy long-term call. So when we buy a call, we are actually wanting the stock price to go up, which actually the stock price, most of the stock price of the good companies will go up eventually, regardless of if you give them a long time frame, it surely will go up unless something happens. Yeah. So that's why we are looking at long term with 180 days and above. The longest term, the better. So the other term that I want to introduce is called a buy lead call. A lead call is actually when you buy a call that is more than 9 months expiry, then that is called a buy lead call. And also, this strategy, it's best to buy call at the money, which is at the around the stock price currently. This is because the IV of the options contract is also varies across the at the money, in the money, or out of the money. So actually, when it is at the money, the IV is actually the lowest. That is why we tend to choose at the money cost. And as you can see here, we are looking for low IV, which is less than 50% as a rule of thumb. This is because IV is also part of the premiums of the option contract. So when we want to buy a call option, we actually want to pay less premium. We want to use less money. That's why we are aiming for low IV. And then the next one is buy when there's a big rate day or touching a strong support price. Or you can, if you are conservative, then it's best to wait for a confirmation. This is with regards to technical analysis. And for buying a call, choose a strike price that has a high open interest. This open interest, we advise to have at least 300. This is because if there are more people willing to trade out there, it is a higher chance for you to get the order filled. If it's too low open interest, you may never get the order filled. And even if you get to buy call the options contract, but later on, when it's near to expiry, when you want to close it, the OI open interest is too low, you may not be able to close it as well. So that's why you need a high open interest for the strike price that you choose. So if let's say also if you are looking at the money strike price, sometimes the at the money strike price has a very low open interest. So you can actually choose a few strike price above the money at the money. So later on, I'll be talking about this a few examples. And the last one is close and take profit when DTE is less than 90 or 120 days away. This is because as an options trader, we do not actually want to own the shares or sell the share eventually. So that is why we only want to sell away the options contract itself. So when the DTE is very near, as I mentioned before, the time value is decreasing very fast. That's why we do not want that, because we are actually buying a call. So that's why we must close it before 90 to 120 days away. And the last thing is cut loss at negative 50%. So when your contract is at a loss, negative 50%, it's best to cut loss and use that remaining 50% to enter another contract. So let's go into the example. In this example, I use AMD. As you can see here, this one I screenshot from the chart trading view. Here I have put in 3rd of November because based on technical analysis, this is a very good point of entry. And at that time, the price is actually $76. So let's see at that time, 3rd of November, I'm actually using a think back. So there's a function in think of stream for you to use to track back the past options. So for example, this 3rd of November, yeah, time travel. So actually this one let you can actually do research and to find out how your options contract is doing if you really did went in at that time. And you can also actually look at the risk profile and probability analysis for future analysis. So for now, this 3rd of November, as we are buying a long-term call, we are choosing the longest term, which is January 2023. So at that time, the price of AMD is actually $76. So at the money, it can be 75 or 77.5 or $80, for example. So as I mentioned, we need to look at open interest. So that is why I will highlight this strike price of $75 is because it has quite a high open interest, which is 1,300. And this is the price of the options that you need to pay to buy the call. Normally, we use a mid price, which is the average of the selling price and buying price of the contract. So basically, we add 2 together, divide by 2, and the total call option you need is $2,480 to buy this contract. And why I choose 2023 as well is look at the IV. The IV is less than 50%, so it is okay to buy. If you want to have a lower capital, in this case, you can also consider a strike price of 80, which also has a very healthy open interest and is not too far away from the current stock price. So that is also another one that you can consider. So by following the rules, when we enter at November, 3rd of November, and when it is February 5th, which is here, the stock price 87.9. Your trade price is 2480. And by the time for the 5th of February, you actually have a profit of $542. So this actually shows how you can profit from buy call options. So if actually, because this contract is until 2023, you can just leave it for a long time and you can keep monitoring it. And who knows, maybe AMD keep growing and you will have more profit. So for another example, I compare a short-term buy call. Because for some people, this options contract, if too long-term, they may not be able to afford it. So that's why they are looking into shorter term. Let's say, for example, this one, April 16, with a IV of 51%, which is still okay. And if also considering the same strike price 75 with an open interest of 400, which is also okay, the mid price is actually these two divided by 2, which is 1,110. So this options contract is actually about almost half of the long-term one. But because the date to expiry is much shorter. So as a comparison, I use the same date to analyze, which is 5th of February. Your profit actually is only $382. But if we compare it side by side, um, the shorter term one actually gain a higher percentage because it is lower in value when you buy it. But the other thing I want to talk about is the time decay. Because it is a shorter term, as you can see the theta, this is another term for time decay. So for this options contract for the April one, the theta is actually 3.38, which shows that your options contract will decay by 300 every day. That is very fast. So you do not want that risk, because what if the next day AMD never go up, then you'll lose this amount every day. So that is not very healthy. So although ROI is actually higher for shorter term options, the risk is higher due to time decay. So are everyone okay with this buy call? If you are okay, type in 2. Okay, that's good. What about the others? Okay. Okay. Okay, good. Okay. So now, after understanding the most basic buy call, then you can actually try to implement it using your demo account and try to see how it can help you grow your portfolio. So the next strategy I would like to introduce is sell short-term put. So for a sell put, we actually want to sell a shorter term because we want it to expire worthless so that we get to keep the premium. And we do not actually want to buy the shares. So that is why we are looking at 30 days and below. And for sell put, we actually sell out of the money or a strike price at a strong support price. This is so that the price of the stock do not actually go lower than your strike price. If it does go lower, then you really need to fork out the cash to buy the shares. So for a selling strategy is different from buying, because selling you want to earn a premium. So that's why you need to choose a higher IV, more than 50% to be ideal, to be more profitable. And for a sell put, you also look at a big red leg or touching a strong support price to sell a put. this increases the chances that you are correct. And similarly, every time we trade options, we need to look at a high open interest options contract and make sure that you have the cash ready to buy the 100 shares at the strike price. So in this example, I use Pinterest. So I was showing the November 10 day when it drops quite a lot, and it is at a good support at a EMA 20. And at that time, the stock price is actually $55. So similarly, I go to this options chain and I choose $50 strike price. The first reason why is with regards to open interest, which is 3,400. The other reason is, as we can see, 50, the price actually get up from $50 to $60, $65. So it's actually showing that the stock has a very strong buying power at $50. So that's why $50 will be a good support for Pinterest at that time. So that's why I choose a strike price of 50. But of course, you can choose more out of the money, which is much more safer. But as you can see, if it is far further away, the premium price that you get is actually lower. So in this example, for the strike price 50, your sell put actually is, you can earn a total of $207. So what kind of profit and loss we are talking about? So remember that selling put, you need to prepare a cash to buy 100 shares. So in this case, 50 times 100, which is 5,000. So your profit is actually 200 divided by 5,000, and you get 4%. And you can see that this contract actually expires in 38 days. So is this a good good profit in 4% in 40 days? So that is how we actually profit by selling put. Another example I want to show is AAL, which is American Airlines. In this case, when it was October 28, the stock price is actually $10.65, which is at a very strong support, horizontal support. So that is also a very good time to sell a put for the this stock. So I'm actually looking at strike price 10 because, as I mentioned, it is a very strong horizontal support. And look at the open interest, it is very high. That means that a lot of people are trading it. So your chances of getting your orders filled is very high also. So in this case, the premium that you earn is actually $56. And the amount of money you need to prepare is only $1,000. So you can actually pocket 6% in 23 days. So this is a much better deal when compared to Pinterest. So is everyone okay with sell put section? If you have any questions, you can voice out in the chat box. If no, I will continue in a while. Okay, so no question. I will continue to the next section, which is selling short-term call for income. So just now I forgot to mention, selling a short-term put is also for income. The selling of options is for income is because the percentage of profit is actually much lesser. As you can see, it is just 6%, 4% or something in 1 month. But for buying a call, your profit is actually much higher. It can go to 100%, a few 100%, or even 1,000%. So for sell call, same thing. You want to sell short term because you are collecting premium and you want the options contract to expire much quicker. So similarly, you also sell out of the money or at a strike price that is a strong resistance price. And same, you want to sell a high IV contract. You sell on a big green day. This is opposite to selling put. So you want to sell a call on a big green day, and if the price is touching a strong resistance price. Similarly, you need to look at higher open interest. And in this case, you make sure that you have 100 shares or a buy call that is in profits. So because if the buy call is not in profits, it means that the stock price is actually lower than, most likely lower than your strike price. So you cannot really sell call and it's not profitable for you to do so. And the last thing is do not sell call on high growth companies. This is because high growth companies, the stock price can go up a lot in a short term. So if it goes high further to your sell call strike price, then you are in danger. Basically, you have to sell your 100 shares if you are exercised. So in this example, I use KO, which is Coca-Cola. Actually, for a sell call strategy, we can use it for very stable big companies like Coca-Cola or banks or some payment companies like Visa, MasterCard. And always remember that you must own 100 shares or a buy call that is in profits and in the money. So in this example, I'm showing the 11th of November when the Coca-Cola price is actually $54. And as we can see from the past, it's $54 is a strong support, but then after it fell through, it will become a strong resistance. So at that time, we can actually try to sell a call option. So at that time, as we can see, the contract for December 18, which has 37 days left for expiry, the strike price is $55. 55. So in this case, if you sell a call, it's actually in the mid price, which is 68.5. So this is the premium that you get when you sell this call. In this case, because as you can see, after that, the price went down. And if the price go down, your sell call actually is already in profit. You can either take profit directly, or you can wait until expiry. But it is best not to wait until expiry because if it's not much premium left to, if let's say you are, if the stock price dropped to 52, and if your premium is actually you gain more than 80%, for example, you are in profits, you left only 20% more to gain, which is very small amount. So it's best to actually close the contract and take the profit, because as you can see afterwards, the stock price increase again, and this will make your sell call profits lesser. And what if it actually went up above your strike price before the date of expiry? Then you need to sell all your shares. So that's why it is advisable to actually close your options when it is in profits. So for sell call is I actually cover small portion only, because it's not really advisable to use that strategy a lot, because the stock price always goes up and you never know how much it will go up. So that is why we seldom implement a sell call strategy. So for the last strategy I want to talk about is actually buy short-term put to hedge. Buy put is actually the opposite of a buy call. You are foreseeing the stock price to drop and correct in the shorter term trend, because stock price normally actually keep going up unless it is a very worst company, but you do not bet against any stocks. So that's why buy put, we actually look at shorter term, because a market correction is always very short and very fast. So that's why we look at 60 days and below. But you cannot look at too short term because of the time decay. So if you are too short, then the time decay kicks in very fast, and if the market did not correct, then you will lose a lot. So similar to a buy call, we actually look at the money or strike price at a strong resistance price. And for buying options, you also look at low IV, and you buy a put when there is a consecutive big green days or touching a strong resistance price. Similarly, you also need to choose a strike price that has high open interest. And for buy put strategies, mainly investors used to mainly buy put on SPY, which is the S&P 500 ETF. This is because it is riskier to do it on individual stocks. And the strategy, you need to close right away when you are profiting. Because as I mentioned, when a stock price corrects or drops, it's actually very fast and very short. So after dropping maybe a few days, it will rise again very fast. So that's why you need to close right away when you have some profits. And for buy put, you actually use only a maximum of 5% of your portfolio to buy put it's for hedging purposes. So in this example, I'm using a SPY, and I will be showing the 5th of June, which is here, with a stock price of 320. So at this time, as you can see, it has multiple consecutive green day, and it's climbing too fast, too high. So you'll be sensing that a market correction will be coming soon. So at the time, you can actually buy a put for this SPY. So we are looking at 320 strike price, and the price of options is actually 978 at that time. So you need to pay this premium upfront in this example, I'm showing a July contract, which is 42 days left to date of expiry. I chose a short term because I am foreseeing a short term correction. So in the end, uh, in this example, June 10, the stock price started to correct. And at that time, your buy put has a profit of $60. But what happens the next day? On the 11th of June, the market price correct itself here. It drops a lot, it gap down. So your profit suddenly is more than 100% already in just one day. This shows that when market drops, it drops hard. And a buy put as a hedge is that when all your other long positions are losing money, you actually gain back some money here. The profits is awesome for a buy put, but you actually never know when the market will correct. Therefore, hedges always lose money most of the time. This is similar to how insurance works actually. So it's like you want to you won't know when you will get into danger or have some sickness. So actually you keep buying insurance, you're paying a premium every month, every year. But that's why the buyer is actually losing the money most of the time. But when you need it that time, the premiums, the payment, the payout will be good. So this like something like an insurance. So yeah, as Joe mentioned, hedge lose money most of the time. Yeah. So are you all understanding what I shared today? The 4 main strategies. Can you guys type out what are the 4 main strategies that I shared today? Just to make sure that you guys are listening and getting it. Okay, buy call, sell call. Okay, buy put and sell put. So the main thing to take note is that the buy call must be long term, sell call short term, buy put medium to short term, and sell put also short term. Okay. Okay, so I will go through the next slide, which is on portfolio sizing. So after learning all these strategies, you will want to start to try out, and you can actually try out by using a demo account. Okay, so Joe write down 4 main strategies: buy call long term, sell call, if have 100 shares or a buy call, sell put short term income, buy put insurance hedge. Yes, correct. Okay. So after learning all this, you can actually go to your brokerage account. You can try out using your demo account. And the last thing I want to mention is portfolio management. It is very important if you are managing a big portfolio capital. Never go all in one single stock unless you are super convicted into it. Always keep some cash for upcoming opportunities, and always know that you could be wrong. So that is why I mentioned to cut loss when you are making a loss of less than 50%. You can actually try to cut loss. And the other one is you need to make sure that you have a maximum of only 10% of each counter. This is quite a good percentage to follow. If you want to allocate more on a particular counter that you have very much conviction in, you can go ahead. But just do know that if the stock price move a lot, then your account will move a lot as well. If you are okay to take it and you are psychologically good enough to see it move up and down every day, then you can go ahead. And then you must enter in tranches if possible. If your portfolio is big enough, you can split into maybe 3 entries for one counter. So you enter only maybe 3% each time. Because you can never know when is the bottom going to be for the stock price. So when you see it reach a good strong support, you can enter a few contract, and if it drops some more, you can enter more. So that is how you can dollar cost per se. You can dollar cost, and then you eventually you can make more money out of it. So for a big portfolio, do not put everything into options as well without holding shares. This is because options contract is actually a decaying asset because it has an expiry date. But shares is actually an appreciating asset. It is much better to hold share because you can hold forever. But for options contract, you cannot hold forever. That is why if you have a very big portfolio, and depending on your personal goals and investment styles, you can actually allocate different percentage in options and shares and cash. So this is just a rough guide. You can actually use a 30% in options, 40% shares, and 30% cash. So for me, my portfolio is still quite small, and I'm trying to grow it very fast. That's why I'm almost 80% options and 20% in shares. And for the cash, I actually top up every month. So this is how I do it. So it depends on what is your personal goals and investment style. So as a summary for this part 2 options basic strategies, invest in good companies at reasonable price, buy long-term calls, sell short-term put for income, sell short-term call for income, buy short-term put to hedge and portfolio size. And extra pointers, it never hurts to take profit. And the next thing is very important is that sow seeds and let them take time to grow. This is because most people expect to have fast returns, but in actual case, this is not the case in the actual world. So that's why we buy a long-term call. It's just like sowing a seed, and every day you just look at it and build up your conviction towards the stock, and you just hold it and let them take time to grow. And the last thing I want to say is have faith over fear. Do not be always afraid. And when you are always afraid, you will not enter the markets correctly at the correct time. So you must have faith when once you plan the action, you have to take the action and have faith. If it goes wrong, then just cut loss and take it as a learning lesson, and then learn from it. Then in this way you will grow a lot more. So yeah, this is what I'm sharing today. This part 2 is much shorter than part 1. So Any questions from the floor? If there are no questions, okay, question. Let's say I sold PLTR 30 put expired, need to pay 3K. Okay. It depends on when it is expiry date, what is the stock price the PLTR is. So I think PLTR last few days dropped a lot, and it is below 30. So in this case, if it expired on yesterday, then you would need 3,000 to own the shares. I hope that answer your question. Yeah. So yeah, that is why you must always prepare enough cash to be able to hold 100 shares if you want to sell put. Okay. Any more questions from the others? If no question, type in one. Okay, okay. Oh yeah, Jeremy, I think Jeremy came in a bit late. So I'm not sure if you are familiar with the front part that I talk about, which is buy call and sell put. I think I went a bit fast today, but it's okay. Okay, catch up later on. Okay, so if no question, IT. Okay, if no question, I will jump to the next section where I will be asking questions. So question one, it is 2nd of November 2020. John has a small portfolio of 5,000. He has full conviction that TSM will go up and see the chance to enter using TA. So in the chart below, at 2nd of November, the stock price of TSM is 85.7. So what can he do in this case? There can be more than one answer. Okay. Okay, B and D. Oh, Joe. Buy call 85, sell for 75. Okay. Yeah, 75 is a good place to sell put because it's below the horizontal support. And buy call at 85 is also a good entry point. So yeah, SKB. Actually, the answer is B only, and SK is correct. You know why? This is because John has a small portfolio which only has $5,000. So if he sell put at 75, then he will need a $7,500 cash in hand to do that, which he does not have. So he cannot sell put. So B is the only answer. Yeah. So question 2. It is 11th of January 2021. Jane has a large portfolio of 5 million. She has full conviction that Facebook will go up and see the chance to enter using TA. What can she do to maximize her profits? There can be more than one answer. So the stock price of Facebook is actually about 256 here. Yeah, buy call B, and now is a big portfolio, so she can sell put. So B and D is correct. In this case, she may also be able to execute both at the same time, whereby she can, after she sell put 30 days, she can use the premium collected to go and buy a call. So this is one of the strategies that you can use if you have a very big portfolio to do so. You can sell put and buy call at the same time. So question 3, it is 5th February. Jason has 100 Amazon shares with an average price of 2,500 per share. He also has 200,000 cash on hand. What can he do to make a profit? A sell call with 30 days, strike price 3,500. Okay. So the answer is actually A and C. Actually, why the answer here A and C? Because the question is asking what can he do to make a profit. So in this case, actually it's either one, A or C. It's not A and C. Because he has only 100 shares, which he can only sell call for one contract. So why 3350 is also okay? Because if let's say the stock price is lower than 3350, the sell call is profitable and he can close it without doing anything. But if let's say the sell call, the stock price is above 3350, he has to sell the 100 shares at 3350, which he also profited because his average price is 2,500. So both A and C are okay to execute for him to make a profit. So yeah, I think that's all for me today. Thank you and happy investing and trading. Do try out the strategies using the demo account first. And if you are comfortable, you can put in your own money later on to really ride the trend. And for any future updates, you can watch this space, which is my website at thejourneyto1mil.com. So yeah, thank you. I'll pass back to do you guys have any more questions or anything before we end this session? Yes, the link to my website is this. And if you have no question, the other thing is that what are you what do you guys want to learn in the future as well? Maybe we can also prepare some more case studies and things like that to have a few more crash courses for you guys. How to manage portfolio. This one a bit. This actually it really depends on the personal taste, personal investment style, and what are their personal goals to achieve. So this one is a bit hard to talk in general how to manage the portfolio because everyone is different. This one maybe you need to talk one to one or one to a small group of people who are have the same goals and same investment styles. Yeah.
Yeah, if I can add on the portfolio management, I'm not sure can you all hear me? I'm actually in library right now. Yeah, so portfolio management, like what Zipei mentioned, right, is very depending on individual investment kind of goal. What is your investment horizon and how much profit you are planning to generate within your investment horizon, right? So like Zipei mentioned, his portfolio actually comprised of how much? 80% of options, right?
Yeah.
Because he's trying to scale his portfolio very quickly. And I just met one of my friends previously during lunchtime, and he told me that his expected return is only say 10%. So in the case where you are expecting only 10%, your portfolio management and how you portfolio size is very different. You don't need 80% of options, right? Or you will be exposing yourself to too much risk. Of course, portfolio management, we can give you a very general guideline. If you all want, we can do that. But depending on individual, you need to tweak that quite a bit. Like say, Zipei is 80%. For me, I'm currently sitting about 50% options and shares, and I'm trying to put more on options if I have the funds. Yeah, that's for my side.
Okay. So any more?
No problem,
yeah.
Kevin. Yeah, Kevin, are you in the discussion chat room? Because I saw that you are in the main group, but I don't see you in the discussion room. So if you haven't joined the discussion room, you can click on the top banner. Oh yeah, just join. Okay, that's very good.
Okay. So
Yeah, okay. Anything else?
I think if there are nothing else, then I will end this section here. And if you want to have any updates or anything, you can also join the Telegram group. And yeah, so and if anything, we'll update over there. And see you guys. Yep.
Thank you very much, Zipei. It's a good session today.
Yeah, thank you all for joining. Thank you. Bye.
However, last week, what do you shop?